What you're about to learn is going to open your eyes to some pretty amazing possibilities. It's going to save you a whole lot of cash, and it's going to help you build wealth. I'm talking about buying a house for just $900 down. A little house with a little land out in the country. I'm also going to show you what homes you need to look for, the homes you need to steer clear of, and the disadvantages to these types of loans. I also want you to know the questions that you need to be asking and the answers to those questions. Now, my name's Wayne Turner. For nearly 30 years, I've helped thousands of people purchase homes this way. I share that with you so you can trust knowing that what you learn from me is from actual decades of experience. So grab a pen and a piece of paper. You're going to want to take notes. Now, to begin, I think it's important to know this type of home loan. It's called a USDA loan, United States Department of Agriculture, and it's underwritten by the federal government. The federal government guarantees these loans. That means it's a 100% loan, and they're guaranteeing the loan. Of course, you have to qualify for the loan, and we'll get to that here in just a second. But it also falls under the same guidelines as FHA, and that's a good thing, knowing that when you purchase this house, the structure itself falls under those FHA guidelines. Now, being that it falls under those FHA guidelines, the homes that you need to steer clear of and the homes that simply don't qualify for this type of home loan are single wide trailers. You know, there's double wides, mobile homes, and then there's single wide trailers. A single wide trailer will not qualify for this type of loan. However, a modular home or double wide will qualify for this type of loan as long as the home itself is on a permanent foundation. That means it has to have a foundation underneath it, it has to have underpinning, and it has to be bolted and secured to the earth, just like a traditional stick-built home. Now that you know what homes qualify and which homes don't qualify, you need to get qualified. And there's a difference between being qualified and being approved. Being qualified, you're just talking with the mortgage lender on the phone, and you're telling them what you think your credit is, your income, and your taxes, and all of that, right? To fully get approved, you fill out an application, you give them permission to pull your credit. But listen, your credit score has to be 620 or higher. You have to have 2 years on the job, and you have to be current on your income tax. You have to have filed your income taxes and show that you don't owe any money to the IRS. Those are the big three things. And a lot of people ask me, well, Wayne, what about if I've been on my job 6 months, but it's the same line of work? Listen, if you're a welder and you work for one company for 5 years or 2 years or 3 years, and then now you're at a different company, that's fine. As long as it's in the same line of work. If you're a pressman, electrician, if you're an accountant, you're a teacher, it doesn't matter who you work for as long as it's in the same line of work where your income is coming from. Now, once you get approved, you're probably asking, Wayne, where are all these homes? How can I find these homes? I'm going to put a link below where you can actually search once you're approved. Once you watch this video, keep taking notes. It's going to show you where these homes are located. You have to know they're on the suburban outskirts of major city limits. If you're in the city of Atlanta, if you're in Nashville, if you're in Kansas City, if you're in major metropolitan cities, these homes don't qualify. Once again, it's USDA, United States Department of Agriculture. So you're going to be in the suburban areas. And listen, it doesn't have to be on an acre or 2 or 5 acres. It can simply be a quarter acre of a lot. What's really cool about this is if you want to move out a little bit, you can, and it only costs you $900 down to purchase these homes. Now, to make an offer on a home, once you find the home, you simply make an offer. But it's important to remember that the lender that you speak with to get approved, you have to express to them that you're getting and want to get a USDA loan. That lets them know that you're not looking to put a whole lot of money down. Now, one of the disadvantages to this type of home loan is you still have to pay your closing cost. The flip side of that, which can be a really good thing, is 90% of the time, the seller can pay your closing costs for you, all of your closing costs. So if the seller pays all of your closing costs, all you need is $400 to do the appraisal, $500 to do the home inspection, and you're in a house for $900. Now, once you secure a contract on the house, don't make the mistake of not inspecting the home. It doesn't matter if the home is brand new, because some of these homes are out in some rural suburban areas and they're brand new homes, and they too qualify. Doesn't matter if it's a brand new home, doesn't matter if it's a pre-existing home, doesn't matter if it's a double wide mobile home. Inspect the home, and once the home's inspected, the inspector is going to show you exactly what's broken or what's not working to its intended function. From there, you can address it with the home builder or the seller and say, hey, I still want to buy your house, but these items need to be fixed. Will you fix these for me? 99% of the time they'll fix those items, or they'll tell you, no, I won't fix all of them, but I'll fix most of them. And at that point, you can agree and move forward with the purchase, or you can simply cancel the contract and go find another home. Now look, don't forget to do an inspection on the well or the septic system. A lot of people say, oh Wayne, I wouldn't have a well or a septic system. Personally, I prefer it. I don't have to run anything through the city water. I don't have a sewer bill. I don't have a city water bill. I'd rather have it and do it all myself. When you buy a house that way, you want to make sure these three things happen when it comes to that inspection. One, you get the well inspected. The water, you want to make sure that the water coming up out of that well is okay. Two, you want to make sure that the pump is working properly, because it pumps water out of the ground, it holds it in a tank, and it keeps it around 50 to 70 PSI, pounds per square inch. So when you turn the faucet on in the house, you actually get a good stream of running water. The third thing is the septic system. You want to make sure that the septic system is up to par and it's working properly. Oftentimes the city, the county, the parish, they'll make you pump the system. They don't make you pump the system, but these are things that you can ask the seller to do. You just simply tell them, I want to make sure that the septic is clear and working. I want to have it inspected. And you can also ask them to have the septic system pumped. That runs around $400 to $500. That way, when you take possession of the property, you know your water's clean and clear, your pump's working good, your septic system is good, and the septic system is completely empty. Now, something else you'll want to get, and I think this is really important, and I don't care if it's on a really small lot that's 50 feet wide by 100 feet deep, or if you're on 10, 12, 50, 100 acres, you need to get a copy of the survey. And if the survey doesn't show the flood zone, you need to find out what the flood zone is. There's flood zones A, B, and C, A being the most severe, C being the less. You need to know the flood zone, and you want to take that survey during your due diligence inspection time frame, which is typically 10 to 14 days, and you want to walk the property. Listen, it's not a bad idea to ask the seller to walk the property with you. That way you see the meets and the bounds, you know where all the markers are, and you can see with your own two eyes whether or not there's anything that's encroaching upon the property that you need to be aware of. Now, if there is anything encroaching upon the property, you want to know it before you take ownership of the property instead of after. If you do it before, then you can simply have the seller address it. Maybe there's a neighbor's storage building, a swing set, or a fence on the property. It can easily be resolved. The next thing in line is the appraisal. The appraiser is going to come out and appraise the property. They're going to make sure you're not overpaying for the property. It's worth what you're purchasing it for, and the bank's not overlending. From there, the title company, the closing attorney, is going to do a title search. They're going to make sure there's no back taxes, liens, encumbrances on the property. I always tell people, once you close on the purchase of the home, you're going to be required to have a title policy through these types of loans. That's a good thing, because that title policy is a one-time thing that gets paid, and it's all part of those closing costs if the seller pays those for you, but it covers you for the entire time that you own that home. You see, one of the things I always suggest people do is to get out and talk to neighbors during their due diligence time frame, that 10 to 14 days. You'd be amazed at what you could find out from neighbors by simply asking them what they like about the schools, what do they like about the neighborhood. And the big one is, if they had it to do all over again, would they purchase their home? Now, if they tell you no, simply ask them why. What is it? Is there something about your home or the neighborhood? Because you're about to plant roots and make it your neighborhood. Now, the actual closing will typically take you 30 to 45 days. You'll sign about 75 documents, and in those documents, it quite simply says if you don't pay, you don't stay. Now, a lot of people say, well, Wayne, what's the payment run before I even get qualified or get approved? Just know this, if the interest rate is 7%, it's $665 for every $100,000 that you borrow. You could double that if it's a $200,000 home. You can triple that if it's a $300,000 home. Now, a lot of people ask me, Wayne, what is the income limit? The income limit between 1 and 4 people in your household is around $112,000. That varies depending on your state. It also varies depending on how many in your household. So if you're 5 or more in your household, at that point, the income limit is bumped up to $148,000. $148,000 is your maximum income. Now, keep in mind that payment, $665 for every $100,000, is just your principal and interest. That does not include your taxes, your homeowner's insurance and your private mortgage insurance. You still have to pay those things. A good rule of thumb is around $1,000. That will cover your principal, interest, taxes, and insurance and your PMI for every $100,000 that you borrow. A $200,000 house runs you about $2,000 a month. $300,000 house runs you about $3,000 a month. Now, people ask me, Wayne, what is the home limit? There's no home limit as far as price. It's just that income. So as I mentioned, if you're a household between 1 and 4, your income is limited to around $112,000, meaning you can't make any more than $112,000 of your gross income. And if you're a family of 5 or more, you cannot exceed that income of around $148,000. But please know, I'll put a link below. You can check your areas because it does vary depending on your county, state, and parish. Now, a big question a lot of people ask is, Wayne, do I have to pay this money back? No, you don't have to pay this money back. You're borrowing the money. They're giving you a 100% loan based on the value of the house. And you can also sell that home at any time. And when you sell that home, you're not charged or paying any penalties. Another question people ask is, what about self-employed? Can I purchase a home this way if I'm self-employed? Absolutely, but you just have to know that they're going to look at your gross income, because oftentimes when you're self-employed, I too have been self-employed for nearly 30 years, you write a lot of that stuff off. So they want to look at your gross income. Another question people ask is, what about citizenship? Do I have to be a United States citizen? No, you do not have to be a United States citizen to purchase a house with a USDA loan. Now, another question you want to ask is, what would disqualify you from getting a USDA loan? Well, if you've got 30, 60, 90-day lates where you've been behind on a credit card in the last year, that's going to really bruise your credit. It's going to keep it under 620. It's going to make it a little bit more difficult to get it over that 620 hump. The other is a foreclosure. If you've ever had a foreclosure on a property in the last 5 to 7 years, that's going to be a challenge. The third is a bankruptcy. If you've got a bankruptcy, it's really important to know that if you've had a bankruptcy, as long as you're 2 years past your discharge date, you can get an FHA and or a USDA loan to purchase a piece of property. But here's something that people really miss, and they make this mistake. If you contract a house, before you close on it, do not buy anything. Don't even spend cash. Don't put anything on credit cards, because the last thing you want to do, and it's happened, believe you me, is you go buy a car, boat, motor home because you're qualified. Trust me, they pull your credit the day before you close, and if they see that you've drained your bank account, or they see that you've spent a lot of money, you've racked up a lot of credit, a lot of debt, they will cancel your loan before they even give you the loan. Now, there are disadvantages to this USDA loan that you need to be aware of. One is private mortgage insurance. If you're paying PMI, it never comes off. It's always there until you physically refinance the home loan, until, say, a conventional loan. That's when the PMI will be taken off. Other than that, it's always on there. The second thing is you've got closing costs. The good news with the closing costs is the seller can pay all of your closing costs. It runs around 3.5% in this case of a loan amount, which is the same as the purchase price of the house, because it's 100%. Thirdly, these are homes in rural areas and suburban areas. They're 30 to 45 minutes or more outside of major city limits. And the fourth thing is you're limited on your income. So if you're between a household of 1 and 4, you make around 112 or less, you're good, you can qualify. If you're a household of 5 or more, you're around 148. But as I mentioned, you want to check your county, your city, your parish, your state, and make sure. I'll put a link below. So listen, thank you for watching. I hope you enjoy this video. Be sure and give me a thumbs up, subscribe to the channel. I promise you will learn something new on every single episode.